Hi there folks, today I'm going to share a few things that I've learned about zebras and the insurance industry. So first we're going to talk about how zebras buy life insurance. So here in this picture we can see a lion hunting zebras. There's two things we know about zebras. They have black and white stripes and they run in herds, especially from lions. So it's thought that the black and white stripes help to confuse the predator as it's hunting the zebras. And that helps the zebra blend in with the crowd, so it makes it more difficult for the lion to single him out. Because we all know what happens when the lion is able to single out a zebra. He's pretty much going to get eaten. So what does this teach us about insurance? It teaches a few fundamental basics about insurance, and that's the law of large numbers and the law of averages. And what we can see from the zebras is that when they run in the groups, they're essentially purchasing life insurance, because that reduces the chance for any one zebra of being caught. So it reduces their odds as a group. Now we know that one lion may get eaten, or one zebra may get eaten, but the zebra that stays with the pack runs a far less risk of actually being eaten. So that's how he purchases life insurance. He runs with the group, and he's got the stripes. So this is the lion, or the zebra, that did not run with the herd. He got singled out by the lion. So let's look at a group of people. If we're able to dissect a group of people and organize and categorize them by common characteristics, we can start to predict certain things about them. We've got some people, if we're able to put them in a group, for example, people that have certain medical conditions, we put them in a group, we can say certain things about them, and so on and so forth. If we're able to group people by certain characteristics, we can start to then analyze them as a group and use statistics to help us determine things about the group. But the minute we are able to single out one individual, like this random guy here, we cannot then start making those same statistical predictions about him as an individual. For example, this guy, we don't know, even if we knew a lot about him, we would not be able to tell, for example, what his individual life expectancy would be, when he would pass away and due to what cause. For example, going back to the life insurance with zebras, we don't know what kind of lion is going to get him. But as a group, if we're able to put him in a group, we can start to say, okay, we know so many of these people in that group that share the same characteristics. We know they exhibit certain characteristics and qualities. At that point, we can start to say things like, okay, we know X percent will be killed or die, pass away in a certain time frame. So that's essentially how life insurance companies work. They pool people together and organize them in categories. So this random guy, the minute he steps away from the herd, we can no longer start making predictions about him. So same is true for things like homeowners insurance. Homeowners, we can start to categorize them in groups by zip codes, by claim history, by size, things like that, to start making some predictions about that group. Likewise with auto insurance. Have you ever wondered when somebody gets a ticket, why sometimes their insurance rates go up, or that one accident? Well, what happens is you were in one statistical group that had experienced a certain rate of claims or a certain dollar amount from the company. Now, if you have a ticket or an accident or some sort of moving violation or whatnot, at that point, you get moved into another statistical category of folks that share those same characteristics. So those are a few basic insurance concepts. And it works for life insurance, for auto insurance, for homeowners insurance, and essentially using the law of large numbers and law of averages to group people into specific, or groups and categories with specific characteristics, to then make statistical predictions about those individuals as a group. So next time you go to the zoo and you look at a zebra, think of him as in his life insurance policy with running with the herd, and think how that might apply to you and your insurance, because I often hear people say, oh, well, that insurance product is more expensive, But essentially what you're doing is you're paying a premium to transfer that risk to a larger group, the insurance company. So as an individual, again, if you were to lose your home in a fire or flood or any other hazard, then that would be potentially devastating. If you've got a $200,000 home, well, you've lost a great amount. The loan or the bank isn't going to forgive your loan just because the house burned down. That's why a lot of lenders will require you to purchase homeowners insurance. But the state doesn't necessarily require you to purchase other things like life insurance. So I hear some people complain about the cost of that. But think of the cost of not owning it. So as an individual, me, for example, I'm a father of 3.5 kids, and I've got a wife who's dependent on my income. If something were to happen to me, that would be financially devastating to my family. So what we can start to do is put a dollar amount on that financial burden, and I can transfer that risk, let's call it $1 million in future income that I would bring to the family, and I can, for a small premium, transfer that risk to the insurance company because they can then group me with other people that are like me and make statistical predictions, thereby saving me money, saving other people money as well. So it's a more efficient way to handle large impact, low probability type of things. In other words, if there's a low probability but a high potential impact, it's something insurance is very useful to cover. Now, if something is high risk, high impact, it's just to be avoided. And now if something is high or low impact and high probability, you don't really need insurance. That's why, a lot of people, financial planners, would recommend not buying the insurance on a cell phone, or the extended warranty on maybe a small appliance, something like that, because you have higher frequency but lower impact. So insurance really isn't necessarily the most efficient way to cover that cost. So just remember, high impact, low probability, and that's where insurance is the most efficient. So hopefully these zebras have taught you a thing or two about insurance, life insurance, auto insurance, and all the other insurance products out there. And hopefully you are now a more informed consumer as you shop for your insurance products. Keep that in mind, that you're being placed in a statistical group, and that grouping, if you're able to be a part of that group, just like if a zebra is able to be part of the herd, his risk financially, or our risk financially, is lower because we transfer that risk to the group. Thanks for joining, and until next time, take care.